What would your counsel be to investors? It seems like for investors with very long time horizons, it shouldn't be a big deal. They make it through sort of a tough next decade, but maybe better returns after that. But how about people who are retiring into this market environment? That's a fairly meager return expectation. What should retirees be thinking
first,
about?
Never underrate the possibilities that I'm wrong.
Okay.
But having said that, I think an investor is wiser to plan a lower return rather than plan a higher return.
Right.
Because if you've got much more money when you retire than you expect, well, there are worse things that can happen to you in this life than
right.
that. But if you've got much less, there may not be many worse things. You've got to lean on your children or something like that. But I'd say a couple of things. One, stick with the market return, whether it's the bond market return. Don't try and do better. Don't go out and buy commodities or gold. Don't buy hyped up real estate master limited partnerships. Don't buy commodities. I mean, the list of don'ts could go on forever. Just stick with the market. Don't try and do any better, because once you get out, that means owning differently than the different portfolio in the market. The chances are just about the same, and you'll do worse than better in a low return environment. I think that's bad. So you're consigned to a low yield, although I should quickly add that yields are not as bad as people think, because real yields are not that far from their historical norms, because we had like 4% inflation in the last 50 years, and now we're looking at maybe 1 or 1.5%. So real yields are down. Real yields today are probably negative for the Treasury bill, and they were probably positive by about 1%. Not Treasury bill, Treasury 10-year. And for the last 50 years, they've probably been about positive 1%. That's not a huge difference. So it's difficult. So here the options are stick with the market return and draw down some capital. Do not reach for yield.
Well, that's been a big challenge with retirees. Many retirees have been gravitating toward higher yielding sectors, whether high yield bonds or high income stocks.
And those high yield bond portfolios, I'd warn any investor, the difference between high yield bond portfolio A and high yield bond portfolio B can be enormous. And we like to think we run the highest high yield bond portfolio around, which we can afford to do because of you guessed it. We can provide the same yield because of our cost, which for our high yield bond fund is probably 30 basis points or something. Very low, and the industry is probably 1.5. So we can take a 1.5% lower yield and therefore reach for less yield. So be very careful about the selection I would give investors. And if you want to do that, it's not awful, but if you want to do it only in limited terms, should your bond portfolio be a third in high yield bonds, for example, I would say that's too much. These are just judgments, personal judgments, flawed. But be careful about going deeply into any other sector rather than seasoning your portfolio in it. So you can withdraw a little capital, and if the market does a little better as time goes on, you can maybe even increase that withdrawal. So that's what I think really have to do. And then for younger people, you have to save more. And it's not easy, I know that. You got all these conflicting things. You're trying to build up a college account. You're trying to do all these. I mean, the demands are great and enormous, and a family of modest means simply can't do it all. So it's save more if you possibly can. And as time goes on, I'm a great one for saying stay the course, to say the least, but change your course a little bit if it turns out that in the next 5 or 6 years we get very good returns, and those returns that will bring us down to what I've talked about don't come a little further off in time. You might want to withdraw a little or something. I'm not for market timing, but I am, you can't do a family financial planning without thinking about, some integration of the income that's actually being yielded. And those, by the way, are the returns on the funds that we talked about, not the income yields. Stocks yield 2%. You can get a 2.5% portfolio of bonds. So in a balanced portfolio, you're getting 2.25% a year before cost. Here you're going to be lucky to get 1%. So be careful about cost. always. I mean, it's just so obvious. Most obvious the money market fund, and which people are leaving now because of the gates that have been put up there, the possible gates that can go up. It'd be interesting to see how that comes out. But I always, an editorial comment, I thought it was better, the money market fund shouldn't be used in an investment account. If you need the money, short-term savings account's fine. But you should be using short-term bond funds. And
within your investment portfolio.
In your investment portfolio, yeah. Short and intermediate is what I would do. I don't do long, because I just think I'm reading people's minds now, but most people can't deal with the volatility.
The volatility isn't very bond-like, is it?
Yeah, exactly. If you just don't look, you'll be okay.
Right.
Don't peek.
Right.